It's March 17th, St. Patrick's Day. The world is wearing green, but the smart money is staring at the gold. We're sitting at $5,000 an ounce. To the retail crowd, that looks like a victory lap. To me, it looks like an insurance premium on a world that's caught fire. Gold has reasserted itself as the only ghost in the machine that doesn't blink when the bombs start falling. It's not just a hedge against war anymore. It's a hedge against the very system that prices it. When fiscal deficits become the new normal, gold is the only exit sign that isn't made of paper. If gold is the ghost, silver is the grunt. It's the metal that actually has to go to work. We are entering the 6th consecutive year of a structural deficit. The numbers from the Silver Institute are in, and they're brutal. A cumulative shortfall nearing 1 billion ounces since 2021. That's a 4-to-1 leverage ratio at best. Some days, it's 7-to-1. It's a systemic stress test disguised as a futures market. If even 25% of those contracts stand for delivery this month, the clearinghouse doesn't just sweat, it breaks. We're seeing mechanical liquidations and margin hikes of 10% just to keep the weak hands from calling the bluff. They aren't trying to find a price, they're trying to save the system from a physical default. Think about that. We are burning through above-ground inventory to power AI data centers, 5G towers, and the solar grid. Total supply for 2026 is sitting at 1.05 billion ounces, but demand is a shark that won't stop eating. Once that silver is soldered into a circuit board, it's gone. You can't central bank your way out of a physical shortage. You can print $1 trillion, but you can't print an ounce of silver. Now, let's look under the hood of the COMEX. This is where the alchemy of debt happens. Right now, registered silver inventories, the stuff you can actually take delivery of, are hovering between 80 and 105 million ounces. But the open interest? The paper promises? That's sitting over 400 million ounces. That's a 4-to-1 leverage ratio at best. Some days, it's 7-to-1. It's a systemic stress test disguised as a futures market. If even 25% of those contracts stand for delivery this month, the clearinghouse doesn't just sweat, it breaks. We're seeing mechanical liquidations and margin hikes of 10% just to keep the weak hands from calling the bluff. They aren't trying to find a price, they're trying to save the system from a physical default. The wide moat is collapsing because the bridge to reality was made of digital ink. Large industrials are already routing around the exchanges, signing direct offtake deals with mines because they don't trust the COMEX to have the bars when the lights go out. Don't get distracted by the daily paper price action. Watch the vaults. When the registered inventory hits zero, the 180-degree turn becomes a vertical line. Tighten your stops. Protect your ballast. Because in 2026, the only thing that matters is what you can actually hold.